The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. Congress has taken up the issue of tax reform in 2017. When it comes to taxes, economists from across the political spectrum are often in agreement on one principle: eliminating deductions currently allowed under the federal income tax. Why do economists so dislike tax deductions that often allow so many Alabama families to reduce their tax bills? The answer illustrates some of the enduring truths in economics, but the advice also illustrates some of the pitfalls of economic analysis of public policy which ignores the incentives that politicians face. What are the pros and cons of eliminating tax deductions? Joining me on EconVersations today to talk about this topic is my colleague from the Johnson Center, Dr. John Dove. Welcome back to the show, John.
Thanks again for having me.
Well, today we're going to change things up, and you're going to ask me the questions here today on this topic. So, without any further ado, why don't we get started then?
That's right, and thanks again. So, this has been the hot topic lately, tax reform and everything else. Obviously, we've seen the House and Senate both pass different versions of some tax reform bill. Mm-hmm. And as you mentioned, one big issue that economists have that there's a lot of agreement about is this idea of, trying to broaden the tax base and also simultaneously lower tax rates. So I guess, to begin with, specifically, what do we mean when we talk about the tax base, and what does it mean to actually broaden that base?
Well, the tax base would be the amount of income that the income tax actually gets applied to. So one way to think about this is that when you're doing your taxes, you end up with your taxable income. Mm-hmm. And you start with your total amount of income, and then after all your deductions and everything, you'd end up with your a taxable income, or adjusted gross income. And the idea behind base broadening would be to make that adjusted gross income or taxable income amount basically equal to your entire income. And that would be a completely broad base to tax, in effect, all income that comes in without any deductions, exemptions, or other ways to somehow have some loopholes to hide income in.
Okay, so based on that, then what are some of those specific deductions that are on the table right now and have been discussed?
Well, this year there's been talk about trying to reduce the size of the mortgage interest deduction. It's a very popular deduction that of Americans that actually itemize their deductions. It's one of the most common ones that itemizers would take. Another issue, a topic that's of some controversy, is possibly eliminating the deductibility of state and local taxes, which would in effect mean that particularly in states that have higher taxes, then there would be a bigger impact on taxable income there. And then there have been some other ones, I think particularly with regard to some deductions for teachers. In the House bill, they're going to take away a deduction that allowed teachers to deduct expenses that they had for school supplies that they purchased for their classrooms and so forth. So a variety of other, but the mortgage income deduction and the state and local taxes have been the two ones that have been most in play this year.
Another major issue that you hear politicians and also economists talk about is this idea of revenue neutrality. Mm-hmm. and revenue neutral tax change. What specifically does that actually mean, and how is it actually tied then to the tax base itself and broadening of the tax base?
Well, the idea of a revenue neutral tax reform or tax change would be one that would end up, after you make the adjustments, bringing in or being estimated to bring in about the same amount of revenue as you had before. And the idea behind broadening the base was that broadening the base would allow us to also lower the tax. So if you have a larger base, if you're going to apply the income tax, to more of people's income, you have a larger base, you're taxing more income, then you can have lower tax rates for everybody, everything else equal, and then that would be revenue neutral. You'd be taxing a larger base amount at a slightly lower rate, and you should be able to obtain the same amount of revenue. Now, economists often like to put forward this idea of tax reform or base broadening in revenue neutral terms, just perhaps for political reasons more than anything else. Because if you have a revenue neutral tax cut, then you don't have to jump in and make an argument as to whether we want to make government larger or smaller. We don't have to say, oh, we want to increase taxes overall or cut taxes overall. We'll collect the same amount of revenue. And economists would argue that by broadening the base, we could end up doing it in a way that would be less costly to society. So we could have the same amount of government revenue, which could arguably lead to the same amount of government services, but do it in a way that would be less costly to our economy.
So I guess, tied to this then, another kind of a simple question, but fundamental question is, who is it ultimately then that pays taxes, and why do we pay taxes?
Well, we pay taxes because if government's going to do anything, whether it be have a post office or operate prisons or defend our nation, that's going to require resources. And government has no way to make resources on their own. Resources come from the private sector, which ultimately comes from individuals or businesses or investors in the economy. Somebody has to pay taxes. And so taxes are what transfer these resources from the private sector, from you and I, to the government. And it allows the government then to have the resources to do the things that we would like them to do. And so this is referred to as the burden of taxes.
So it seems then that, when it comes to taxation, it's kind of a double-edged sword, where on the one hand, by paying taxes and having taxation, we can provide these public services that you and I and other people want, but then simultaneously it creates this burden on us and businesses and everybody else. So I guess that brings up an important question then is, obviously there's a direct burden that you and I bear. Are there any indirect burdens that might also be attached to taxation as well? Yeah,
it turns out that, and that's really what this debate ultimately gets down to in total, and that's some of the indirect costs of taxes. For the income tax or any tax, there are going to be taxes of compliance and costs of complying and collecting the taxes. The income tax can be quite daunting to try and fill out. That's why ever since I've owned a home, I've been going to H&R Block. I just don't want to handle with the hassles. Allegedly, my taxes aren't all that complicated, but I'm willing to pay to avoid the hassle, the struggle, the stress of trying to read the tax code and try and figure out what you have to do. People have to keep records. You have to have audits. You have to have the Internal Revenue Service or other. If you're talking about business taxes, whoever's supposed to be paying the taxes, you have to have some mechanism in place to verify that they are actually paying the taxes the way they're supposed to. And whether it be a business or an individual or investor, you also have to be following the tax rules and trying to figure out how much you're in tax you have to actually pay. So there are compliance costs that are inevitable.
So I guess, given all of these costs that exist, it seems like then the tax code itself would lead to some real distortions in behavior, whether it be behavior you and I pursue or businesses pursue. What are some of these distortions, and how costly can these distortions then become?
Well, there's an old adage in economics that if you tax anything, you get less of it. And because when you're taxing something, people are going to try to avoid the tax. And that's going to be inevitable because it's really that attempt to avoid the taxes or the fact that you get less of something when you tax it that it really creates this extra level of cost of a tax. So we have the burden of taxes, which is the resources we have to sacrifice or give up to give to government so the government can do stuff on our behalf. We have obvious compliance and complexity costs depending on how complicated the tax code is. But then we also have the distortionary effect of taxes. And this was economists who use the term excess burden. It's sort of a play off the term burden of the tax, the resources we have to give up to say there's an excess burden. And this comes from the attempt to avoid taxes by letting taxes distort our behavior. So, for instance, if you impose a tax on gasoline, which the federal government and all states do, that's going to affect how much gasoline people want to buy. You tax anything, you're going to get less of it. Back in 1993, under President Clinton, they imposed a range of tax increases, one of which was a tax on luxury yachts. And that was particularly famous because it led to a huge decline in sales of luxury yachts. In part because people thought the tax might be repealed shortly, and it was. And luxury yachts last a long time, and so even if you were wealthy and wanted to get a new yacht to go boating, you could always wait a year or two, and that was what a lot of people did, and that's why there was like a 90% decline in sales of yachts. And it's that distortion of behavior, the fact that people look at a tax on gasoline, they buy less gas, or they buy fewer yachts. That ends up distorting our behavior, and because people do want to buy and use gasoline or yachts, what we're getting less of something precisely or solely because it's getting taxed. And that ends up, so not only do we have to give tax revenue to the government, we have to do with less gasoline or fewer yachts or fewer of whatever government's trying to tax. And that creates this extra burden, this excess burden of taxation.
So a unit tax then, or a tax on a specific good or something like that, would lead to this excess burden. So, another important question then, though, would be, how is it that something like a sales tax or an income tax, which, a lot of people think about all the time because it's right there in front of them, how or does a tax like that actually distort behavior?
Well, our broader taxes also do distort behavior, because although you might think that with the sales tax is applied widely to lots of goods and services, and it is, not everything gets taxed. There are some exemptions to sales tax, and it's also reducing the amount of sales. It's affecting people's choice to consume or buy goods and services for which they have to pay the sales tax versus, say, saving. And so you could be distorting a choice there. An income tax is going to affect the return that people earn when they work. If you believe that people care not just about the aggregate or grossing earnings that they have, but rather their net of tax earnings, then the tax rate is going to affect how much take-home pay people get. And people would be making a decision, well, should I work some extra, or should I work overtime? They'd be looking at how much extra income they get to keep after paying taxes, and not just how much they get to earn. And that's where taxes are going to affect, an income tax are going to affect decisions that people make about how much to work or whether to pursue a raise.
So I guess looking specifically then at the income tax, again, one of the major revenue sources and one that everybody's very familiar with, it seems. Most economists don't necessarily discuss or consider eliminating the income tax, but rather when it's talking or it comes to tax reform, talking about eliminating those deductions which you brought up at the beginning. So how is it specifically then that some of these exemptions and deductions that we've talked about might actually affect or also distort behavior?
Right. So I think that's a really good thing to bring out, because yes, the income tax is going to discourage the generation of income, but deductions and exemptions can affect what people spend their money on. And so let's take the example of the mortgage interest deductibility. Well, if you own a home, you get to deduct the mortgage, the interest that you pay on your mortgage. Now, that's not your entire mortgage payment, and mortgage payment might also include amount for property taxes and homeowners insurance, but a portion of that goes to interest on the loan, and that gets deductible. So if, for instance, somebody could have a $1,000 a month house payment or a $1,000 a month rental for an apartment, that house, owning the house is slightly cheaper because some portion of that $1,000 every month you're paying on that house payment is going toward interest. More so at the beginning of say a 30 or 20-year mortgage than at the end, because it's based on the schedule, but some portion of that's going for interest. And that means that eventually when you do your taxes, you'll get to deduct that interest if you itemize your deductions. And so that $1,000 that you're paying on a mortgage every month might end up actually costing you $800 or $900 once you factor in the fact that some of that's interest income, some of that's mortgage interest, and then you get to deduct that off the taxes, and that's going to reduce the taxes you pay. So it might end up being that your $1,000 mortgage payment is the equivalent of $900. So if you have a household here that was looking between spending $1,000, and if they had to spend $1,000 on renting versus owning a home, they might choose, they might prefer to rent. They just don't want the hassle of owning a home. Maybe they don't plan to stay in one place for very long. But if that owning the home only costs $900 as opposed to $1,000, some people are going to look there and say, well, I guess I would rather own a home because for tax purposes it makes it cheaper. But that actually means that what we're doing is taking somebody who would prefer to rent and via the tax code inducing them to buy a home that's a less preferred option for them, and there's going to be some loss of value. There's some degree of loss of value that has to be factored in, and that's what the excess burden is, and it's there even for all of these tax deductions or exemptions.
So I guess based on that, then, would that suggest then that every tax creates some sort of excess burden? I mean, is that always going to be the case?
That pretty much is the case. In economics and in public finance, there's something we call the lump sum tax. It's like this ideal or sort of like a unicorn of public finance theory, a tax that wouldn't distort anybody's behaviors. But in the real world, every tax we can think of is going to distort some type of behavior. And so there's always going to be a deadweight loss or this excess burden of taxation.
Yeah, and that's my understanding is the lump sum tax itself really isn't even achievable in any sort of real policy way, so that's good to know. So I mean, given then that we have this excess burden and we see that it applies to any tax, right? Does this mean then that taxation itself is a bad idea?
No, not at all. What it does mean is that when we look at a dollar that the government is spending on something, we have to recognize that the cost to us of raising that dollar was more than $1. And because of the compliance costs of actually collecting the tax and then the distortionary effects, that dollar of government revenue might have cost the economy $1.20, $1.25, depending on the exact nature of the tax and the amount of the distortion. So it's going to cost more than $1. That doesn't mean that we don't undertake government spending at all. It just means that government spending needs to be providing enough of an extra benefit to make it worth this extra cost of collecting the taxes.
It's good to be aware of that. So I guess another thing that a lot of economists talk about, though, when they talk about the economics of taxation, is an optimal tax or the optimality of tax. So I guess a couple of things is one, what does that mean? What does it mean, optimal taxation? And then two, how is it that things like loopholes and the exemptions that you've talked about within the income tax, how does it affect this optimal taxation?
Well, optimal taxation refers to the problem of trying to minimize this excess burden, minimize the total cost of collecting taxes. So if we need to have the government spend $1 trillion, then the question would be, what tax or taxes can we impose to have the smallest excess burden? Because we're going to have to collect $1 trillion in resources, and we know there's going to be at least some extra cost on top of that. But if there's some way that we could collect $1 trillion and only impose $100 billion of extra cost on the economy, that would be better than having to impose an extra $300 billion of cost. So we get $1 trillion worth of government spending, maybe for only $1.1 trillion as opposed to $1.3 trillion. So that's what we're trying to do with optimal taxation. And one of the important issues that arise in optimal taxation then is that the amount of this excess burden is going to actually increase more than proportionally with the rate that we're imposing on it for any tax. So if you double the tax rate, the excess burden is going to more than double. In fact, in some cases, it might quadruple. But importantly, high tax rates are going to distort our choices more than low tax rates.
So how exactly then would that play out with the income tax itself?
So if we could broaden the base, then we can have a lower tax rate. So here's just some numbers from 2015. The individual income tax collected about $1.5 trillion of revenue. And national income, not all of our GDP, but the portion that went to Americans as income was roughly around $15 trillion that year. It works out pretty nicely. So if we taxed all of that national income and we needed to collect $1.5 trillion, we need to have a 10% tax on all of that income. On the other hand, if through exempting mortgage interest, exempting state and local taxes, exempting a lot of other forms of expenditures, say we had $5 trillion in national income that we decided not to tax. So our adjusted gross income would be only 2/3 of what our base income or initial income was. Well, then to collect $1.5 trillion, we need to have a 15% tax rate. And so it's that higher tax rate, which means that excess burden is increasing more than proportionally. It might look like a 50% increase in the tax rate, but it's going to lead to more than a 50% increase in the deadweight loss. And that's really how we can have the advantage of trying to broaden the base and lower the rates and have a smaller deadweight loss or smaller excess burden from the income tax.
Well, it seems that, and especially looking at these numbers, that at least on paper, it seems like we have a good idea here, which is, okay, we end up with lower rates, right? We end up with a lower excess burden, and we still end up with the same amount of revenue. Are there any potential problems with any of this?
Well, there might be, and it could particularly arise if you're of the opinion that, well, it always seems like politicians are trying to tax us everywhere. Every time we move, everything we're trying to do. If you feel that we're overtaxed or you feel that government taxes a lot, then you're going to approach this taxation problem slightly differently. Here's a quote from columnist George Will out of the recent that he made during this recent tax debate, and this was with regard to a House proposal that was going to tax universities' endowments. And so the specific issue of that tax wasn't all that important. But his point here is that public appetites are limitless, as is the political class's desire to satisfy them. So if you think of government as really in a never-ending quest to somehow collect more tax revenue from us, then you're going to approach that optimal taxation problem very differently.
How exactly would that play into the optimal taxation problem? Because it does seem to be that this is an issue where there does seem to be creep as far as the things that get taxed and the ways that revenue is raised. So how would that actually play in? Well,
it turns out to actually quite important. And on this point, Nobel Prize-winning economist James Buchanan, he often criticized the traditional public finance theory as offering policy advice as if to a benevolent despot, or ignoring the whole issue of politics and what politicians are trying to do. And in this book with his co-author Jeffrey Brennan, called The Power to Tax, they actually went through and actually showed that if you change what you assume the government's trying to do, instead of, say, collect a fixed amount of revenue, but say the government's trying to collect as much revenue as they could, then all the results from optimal taxation theory get sort of turned on their ear or thrown out. And so a lot of economists' intuition that comes out of there when we study optimal tax theory really doesn't necessarily apply if, say, you have a government that's trying to collect as much revenue as they can. Because then you could see something like over time, you could see economist arguments be used very differently in practice than what we intended them in principle. So economists might be saying like, oh, let's get rid of all these deductions and allow us to lower rates. And politicians say, great, let's get rid of those deductions and we'll lower the rates. But the reduction in rates ends up being quite temporary. And then once the deductions are all eliminated, you boost the rates back up, and you end up collecting more revenue down the road than you could have possibly before you managed to get those deductions erased.
So would there be any additional or just any implications then, especially for the current tax debate, based on Professor Buchanan's work here or any other work that he's done?
Well, I think certainly this entire question of trying to restrain government is an important one, because what we could see is Professor Buchanan used the idea of a Leviathan government, a government that's trying to maximize its tax revenue. Now, that's clearly not quite what we live in, because as skeptical as we might be about the government's intentions, we also know politicians are very reluctant to raise taxes, that raising taxes is a good way to find yourself on the unemployment line if you're an elected official. And so clearly politicians don't feel that they can collect any amount of taxes that they might want. But what we do see is that we're in this world where, in our current world, we can constrain our politicians to some extent, but we can't constrain them perfectly. In some cases, we are able to certainly politicians fear putting or raising taxes in total, but sometimes they do find new ways to tax us, and they do find new ways to tax us, and they don't lose their jobs. So what we actually have is a complicated problem where politicians are somewhat constrained, but not perfectly constrained, and I think that makes this whole issue quite messy.
Well, tied to this then, another question to think about is, if you look at something like the mortgage interest deduction, lots of economists would argue that, that's something that you could eliminate and do what you say, broaden the base, lower rates, but it seems that Congress is almost pathologically unwilling to touch it. And it's been that way for a very long time. So, what's sort of the political economy behind that? Why might that be the case?
Well, here's one where I think we don't really have a very good understanding as economists or public choice economists of exactly what it is about a deduction that makes it work. And in a previous book that Professor Buchanan wrote called Democracy and Deficit, he talked about how for many years, for over 150 years of our republic, the federal government operated under a de facto balanced budget rule. It wasn't official, but it was just considered to be prudent that the federal government should balance its budget, except perhaps when it was fighting a war. And in the 1930s, that went out the window, in part due to John Maynard Keynes's arguments for deficit finance. And since then, well, we've had a problem with the federal government borrowing too much, running us into a huge national debt. And that just goes to show that we have, if we have a rule that manages to constrain government, we don't want to necessarily throw it away too easily. So if the mortgage deduction is something we should be reluctant to do away with, unless we're a little more sure about exactly how we're going to be able to control politicians in its absence.
So based on that, then, what would that mean or imply? We go from a situation where it seems that optimally we would just have one low rate, no deductions, but now you're almost kind of making the argument that, well, deductions can also be a positive and a good thing.
Yeah, I think in sort of a concluding thoughts here I have in it is that the basic argument that economists have from optimal taxation theory is a good one to remember. We do want to keep the base as broad as we can, but we do also want to take into account the possibility that some of those, that it might be more effective sometimes to have a deduction in place that allows people to reduce their taxes that way, as opposed to necessarily trying to control the tax rate. And so there are, I think, some deductions that could meet a slightly higher bar for their elimination. And we don't really have time to get into that today, but I think we just have to be a little more skeptical about what deductions we want to get rid of. Well, Thanks for coming on, John, and asking me these questions today, and thanks for joining us. Join us again next time for another EconVersations.